Move on to Zimbabwe. The central bank over there says a $70 million stabilisation facility will be disbursed by the end of the month to deal with delays in foreign payments. Now, that facility comes at a time when companies have been struggling to make forex payments for raw materials. That's mainly due to the depletion of nostro accounts, which are basically accounts that banks in Zimbabwe have in other banks outside Zimbabwe's territorial area. Now, the government directed banks to reduce lending rates to no more than 12% per annum with effect from April the 1st to support the productive sectors of the economy. The central bank chief also implored the Reserve Bank to preserve foreign exchange in nostro accounts by enforcing market and institutional discipline and domesticating the settlement of local card transactions on international card switches as well. Now, there's quite a lot happening in Zimbabwe. Let's get the gist of all of what's going on down there. Farai Makutuya joins us now live from Harare. Farai, good to see you. Let's start with the Reserve Bank. They referred specifically to $206 million in payments to DSTV. That's the satellite TV broadcasting arm of Naspers, arguing that, quote, the use of hard-earned foreign currency in this manner is not sustainable. Should we expect capital controls to stop payments to DSTV in future?
Well, Rama, perhaps not controls, clampdowns or bans on DSTV specifically, but what I suspect is that the central bank will direct banks, as they are already indicating through various means, to prioritize productive sector use of foreign currency. And so they might say to banks, make sure that 70 or 80% or whatever proportion, a majority proportion of forex payments you're making go to the productive sectors, and then the minority, 20, 30% to those that are deemed to be luxury or non-essential. Clearly what the central bank is unhappy about here is the non-productive use of foreign currency. It's also likely to appeal to them morally to Zimbabweans for them to prioritize how they use their foreign currency. So clearly an unsustainable use of foreign currency here in terms of banning, clamping down or restricting, probably not, just other methods that may be adapted.
Indeed, we'll have to see how that plays out in the long term. Let's talk about the bond notes, though. What's their performance been like so far? Have we seen any material difference to the country's cash shortage?
Well, Rama, what the bond notes have succeeded in doing is replacing the US dollar as the primary currency used domestically. Last year, 90% of transactions here were done in US dollars. It's now been reversed. 90% of transactions are now being done in bond notes. There is indeed a shortage of US dollars in the market, but there's been a ready replacement in the form of bond notes. So domestically, that hasn't really been felt. The impact hasn't been that great. If you go to banks, particularly towards month end, you will still see some queues at the banks, and that's largely because the quantum of bond notes in circulation at 88 million just isn't enough to meet the demand and appetite for these bond notes and the need for hard cash in people's pockets. But you know, there's not much the central bank can do because their release of these bond notes is linked to exports, and so based on exports is how they will drip feed these bond notes into the market. But certainly in terms of replacing the US dollar as a domestic currency, the bond notes have succeeded.
Indeed. One of the other things that was supposed to happen concurrently, the introduction of these bond notes, is pushing more and more Zimbabweans into using mobile money or electronic money. But we're seeing active mobile money user accounts falling by over 1 million. That's roughly 23% between September 2015 and the end of December last year. What triggered that reduction?
Well, Rama, towards the tail end of last year was really the peak or the worst of this cash crisis that we're experiencing here. And, you know, that reduction in the numbers of people using mobile money is a direct consequence, an unfortunate consequence of that. Previously you could send money to someone, pay and transact via mobile money. Towards the end of last year, because of the shortages in cash, if I, sent $100 to someone, they couldn't readily redeem it in full because the agent perhaps didn't have that amount in liquid cash. And so they would be forced to do multiple transactions until they got to the $100, or in the case of retail outlets, they would be forced to buy certain groceries that they didn't necessarily need. And so what that's done is it's pushed up the cost of mobile money transactions. It's also taken away the convenience, which is one of the key features of mobile money. And, that's why we've seen that slump in those figures towards the end of last year.
Indeed, we'll leave it there for the time being. So much to talk about when it comes to Zimbabwe, but we'll leave it there for now. That's for I'm Live, of course, in the Zimbabwe capital of Harare.